as Bitcoin and altcoins, such as Ethereum, soar to record highs and keep the headlines of the newspapers around the globe interested in cryptocurrencies and blockchain, everybody's trying to unravel the mystery of cryptocurrency. Now, Bitcoin might be the granddaddy of them all, but it's not the only cryptocurrency on the block. Today, the name Bitcoin is often used as a genericized trademark for all digital coins. In fact, the majority of people getting into cryptocurrency are flocking to Ethereum, as well as many of the newer coins, including forks from Bitcoin, including Bitcoin Cash, the upcoming Bitcoin Gold. So keep in mind, Bitcoin was the first and is the largest by volume or liquidity. But sometimes, just like when we say Windex for glass cleaner, or Kleenex for tissue, this is what happens when we say Bitcoin. So you have to be careful, because when the headlines are all reading Bitcoin, they're also talking about all the altcoins out there. And there are many of them. As of this morning, I believe I read that there was almost 1,000 different digital coins out there. Now, most of them we can't trade, so they're not important to us. But Ethereum has made the most impressive gains this year after recently being the first cryptocurrency to be backed by major corporations such as Microsoft, Samsung, JP Morgan Chase, and others, what's being called and named the Enterprise Ethereum Alliance, the EEA. Ethereum does code and programming for what Bitcoin did to financial transactions. Now, they're all based on the same blockchain, and they're all related, but different ones have special needs. Like Ripple is all about banking and banking payment networks. So each coin has its own methodology. So for simplicity's sake, think of Ethereum like a more advanced and sophisticated Bitcoin, backed and utilized by major corporations because of its technological advances and its clear pathway to building a decentralized internet. Cryptocurrency seems to straddle the boundaries between commodities and currencies, but most governments are now putting them under commodities. And in fact, in the US, the CBOE, the Commodities Board of Exchange, has now started trading Bitcoins, and you can trade through the exchange, the legitimate approved exchange by regulators, Bitcoin futures. Now, also Bitcoin or altcoins can be spent in hipster food stalls in Camden Market, in pubs in London. You'll start to see ATMs all over the place for Bitcoin. Several US online retail shops will accept Bitcoin as payment method, but it is traded like a commodity. Its volatility hampers its use as an everyday currency. Just imagine, Bitcoin was at 17,000 yesterday and then dropped to 13,000 and change. And if somebody had paid you one Bitcoin and transferred it into your wallet, and by the time you got to your wallet to start to use it or went to pay for something, whatever you were buying, it's only worth $13,000, you'd be quite upset. So this is its drawback as far as it's working as a payment method for simple transactions. Now, as we can see here, the cryptocurrency universe is growing by leaps and bounds. And these numbers aren't even up to date because they are getting bigger and bigger by the moment. Now, it was a big journey, as you can see on the chart, from trading at the beginning of this year at about $700 and soaring up to $10,000, and then in just a few days soaring as high as $17,000 a Bitcoin. And when Bitcoin goes up, it brings along the rest of the currency. Ethereum reached $500, trading at its highest level. And ever since the approval of Bitcoin futures on the US markets, Bitcoin in the last few days has skyrocketed. Now, it all started with Bitcoin. A recently released research study estimates that there were up to 5.8 million active users of cryptocurrency in the world. But Bitcoin still controls 72% of the market. But you imagine 5.8 million people are buying, owning, or trading Bitcoin. When just a couple years ago, there was only a couple thousand of them. Just a year ago, the idea of buying the virtual currency Bitcoin was laughable. After a rapid rise in 2013, the cryptocurrency value more than halved by the mid-2015. After its lowest point, one Bitcoin was equal to about $230. And we're not talking long ago. We're only talking 2 years ago. In September of 2017, Bitcoin hit a high near $5,000. And look at this. Now we're in the end of the year 2017, and Bitcoin is reaching close to $20,000. So you talk about making a profit? Now, given the currency's covert nature, the average person still may not understand how to buy and selling actually works. One of the main reasons for growth and popularity is the adoption of the technology that runs Bitcoin. This technology is known as blockchain. Now, we read about blockchain in the papers all the time, and usually we read about blockchain completely separate from Bitcoin, because the banks and corporations around the world are adopting Bitcoin, blockchain technology to handle payments, contracts, and everything else. So we forget sometimes when we read about blockchain, it is synonymous with Bitcoin, because it goes hand in hand. Bitcoin was developed with the blockchain technology. Now, blockchain technology is quite complicated and has caught the attention of financial companies around the globe. Blockchain is, in essence, a way to move data in a safe, low-cost process. And if you remember, when we talk about Bitcoin or Ethereum, they're digital currencies. They are simply data. Now, to go into step-by-step how a blockchain works and how the transactions work is a little bit complicated. Cryptocurrency is a medium for exchange created and stored electronically in the blockchain, using encryption techniques to control the creation of monetary units and to verify the transfer of funds. Bitcoin is the best known example. So let's give you the highlights of blockchain. In order to spend or receive Bitcoins, a Bitcoin user must create a transaction and broadcast it to the entire Bitcoin network. For a transaction to be successful, it must be added to the blockchain, which is a public digital ledger, which you can't do and I can't do. Now, we can broadcast our exchange, so when you go on a wallet and I want to pay you something and send it to you, I take it from my wallet and send it to your public and private key. If I buy Bitcoins, they are deposited into my account and then I can move them. But I cannot process and add it onto the blockchain. I can just broadcast it. Now, miners are those in the network competing to collect the transaction data, verify the transactions against the existing blockchain, and solve a cryptographic puzzle that allows them to add a block of recent transactions to a blockchain. And for this, they actually receive payment or a reward in a part of a Bitcoin. The fact that so many have the same record and that so many are trying to confirm the same transaction helps to ensure each sequential block of the public chain is accurate. Once a block is added to the chain, it is there forever and becomes a public record, so no one can change it. It is permanently etched into this blockchain. Now, it doesn't have your name and my name on it. It's got long cryptographic private keys that we can't decipher. So it's not sharing any information, but these blockchains and these keys and this encryption all ties back, and everybody's got the same thing. Now, the entity that verifies the transaction adds it to the ledger is called a miner. This is because when a transaction is added to the ledger, new coins are created and given to the entity as part of the fee, garnering the nickname of mining. Mining is one of the most complicated functions involving digital coins. If you think of miners just like gold miners, they are the ones controlling the supply. All cryptocurrencies have managed control supplies. Gold is valuable because of the limited supply. Gold miners have to work hard to mine the shiny metal. In the cryptocurrency world, miners do the dig in the ground, and they supply computer work by solving the pieces of the puzzle. Every 10 minutes or so, mining computers collect a few hundred pending transactions and turn them into a mathematical puzzle. Cryptocurrencies are not regulated or controlled at this time. Now, I have to be very careful here because there are different governments around the world coming out with all different new opinions and all different ideas, and some parts are allowed and some parts aren't. Just like recently, China banned cryptocurrency exchange, but then allowed them to reopen. Some places have banned leveraged crypto purchases. Okay. So there's all kinds of things happening, and you have to watch. But cryptocurrency buying and selling is not illegal by its account. Okay. It is allowed and it is legal and useful, but different governments are trying to regulate it. Mostly they want it's the anonymous side of it. So an exchange that verifies your identity, which is going to happen if you want to use a credit card, a bank account, or whatever else, they are not really closed. They are approved by the government because they are processing everything to protect money laundering and criminality. Okay. Now, the basic idea of cryptocurrencies are tokens of value online without having to rely on a centralized intermediary such as banks. Cryptocurrencies are known for being safe, transparent, and secure transactions. Transactions cannot be faked or reversed, and there tends to be low fees, making it more reliable than conventional currency. So if you've ever needed to transfer money from country to country overseas or convert your money to do something, you know that those fees are exceptionally high. Now, where did all of these digital currencies come from? Keeping in mind that Bitcoin has been around since 2009, which isn't so long, it is the leader in the industry. With the increase in popularity, media hype, and the acceptance of blockchain technology, many new coins have been issued. There have been a proliferation of cryptocurrencies in the past few years, and now there are more than 800 available, many which have low volume and little liquidity. Because there's no regulation or government control in place, many coins are being introduced. Anyone can create a new coin, and this is what you have to understand. Creating a new coin is easy. Blockchain technology is publicly open sourced. If you don't build a community, people don't want to buy and sell it, then it has no value, and so it doesn't make a difference. So you must develop a community who has interest in your currency. Once you have a community that's interested in owning and trading your Bitcoin, you need to attract miners, because miners don't want to get in and do any of this stuff unless they can make money. So unless there's enough transactions, enough people, you don't have miners. And of course, the exchanges also want to make money. So there must be a large enough community to make it all worthwhile and enough volume or liquidity. Now, you need a group of loyal miners committed to the cause who will process your payments even during slumps in price because they believe in the eventual outcome. It all comes to supply and demand and future growth potential. Now, on that same side of the coin, we also have everyone wants to know about ICOs. It's the newest way of people are thinking of issuing new coins and making money. It's a new business model in the crypto network. Before we can start talking about investing in cryptocurrencies and possibly making some profit along the way, we do need to discuss ICOs, not to be confused with IPOs. So let's get to the point. What in the world is an ICO? An initial coin offering is a transaction type designed to help spur and launch new cryptocurrencies and give them some traction. Essentially, it's a fundraising tool designed to boost newly born currency into the online world. The idea is that you invest currently launched cryptocurrencies, primarily Ethereum, and use that to buy a new currency through exchanges. It's somewhat simple. You give the launchers some Bitcoin or Ethereum, and you get some of their future unicorn coins, assuming that they don't exist. So if you imagine, the best way I can say is imagine cryptocurrency as being, in the old days, gift certificates. You go to a department store, and Christmas time you'd buy, or holiday time, or birthday, you'd buy a gift certificate. You would give the store $10 or 10 euros. They'd give you a certificate worth $10 and 10 euros. Now, you would give that to somebody, or you could hold on to it. It actually became, at that point, digital currency. Okay. You can only buy it and sell it or use it at that store. It has a value. Now, how will it go up or down? Now, let's say instead of getting $10 in gift certificates, I went in and got a gift certificate for 2 pair of tennis shoes or 1 pair of tennis shoes. And they said 1 pair of tennis shoes, $20, but it's 1 pair of tennis shoes. Now, I gave that to, say, my daughter. My daughter didn't go back to the store for a year. The gift certificate was still good. Those tennis shoes were now $24. But because she had a gift certificate good for 1 pair of tennis shoes, she got that pair of tennis shoes, which is worth $24. So that $20 gift I gave her was now valued at $24. Now, ICOs are, I don't have a store. I say I want to open a restaurant, and I will give you 10 certificates for a 2-person steak dinner valued at $100 per steak dinner. Okay, you give me $1,000 and I'll give you 20 of these certificates. Okay. You get 20 of these certificates. And these are called software pre-sale tokens, technically. Now, you made a good deal, because if you're going to go to that restaurant 20 times and eat that dinner every time, you're doing all right. So you give one to one kid, you give one to another kid. And 6 months from now, you go into the restaurant and you say, I want my free steak dinner. They say, oh, we don't have that anymore. So what do you mean? Well, we'll take that certificate, but we only offer filet mignon now. And that filet mignon is now $40. So you now have to pay the difference. And you say, but I got a certificate for a steak dinner. They said, I'm sorry, we stopped offering that. This is what happens with these potential tokens. They have a value, but there's no guarantee to that value. And this is why a lot of people are worried about laws and regulations and ICOs, because there's so many coming on the marketplace that they can have the potential, but there's no regulation, there's no laws, there's no release, there's no discussion, there's no public information. So ICOs are, you need to be careful. You need to understand who's issuing the ICO, something about them, because you don't own any. It's not like an IPO where you own shares in that corporation. You don't own anything but a token. So it's not tied to that corporation. So in a similar manner, a developer of a newly found cryptocurrency might choose to say that his or her investors are donating coins to their cause and whatnot. So while this is completely acceptable and falls under the same reasoning for why Bitcoin was invented in the first place, same thing with Ethereum. To decentralize and stop all the crazy fees that go into making these investments happen, it's still relatively questionable. Now, we've talked about the different parts of the market, but once you understand cryptocurrency, once you've decided that you want to enter this crypto revolution, you need to decide whether you want to be an investor, a trader, a speculator, or if you just want a new payment method. You have to decide where you fit in this hipster, cool, revolutionizing, what disrupting new type of finance. Now, there's lots of people becoming Bitcoin millionaires. Like I said, I bought 3 Bitcoins for $700 over a year ago, just out of a fluke, not for an investment. I was buying them so I could learn how they work, so I could do webinars. And I just left them there. Well, I got really lucky. Maybe you get lucky with one of these new coins also. Don't know. But watch our video on getting into the crypto revolution, and you might find that you can get in trading CFDs, arbitrage, or exchange trading or margin trading. So look around for our other videos and see where you fit into this revolution.